Hey friends, welcome back to the channel. My name is Sanjay and today we're going to try and answer that question around how much and how frequently should you be investing into the share market once you've started your journey in investing. And this is most important to people who have ETFs or listed investment companies and want to try and progressively add towards those holdings. So in today's video, we're going to look at the key factors to consider, and then I'm going to take you briefly through an online calculator, because at the end of the day, there are online calculators to do pretty much anything. And look, I appreciate everyone's busy these days, so if you're in a rush, feel free to look at the little seek bar along the bottom. I always make sure in all of my videos to cut it up to show you the different segments. Feel free to skip ahead to the section where it talks about the online calculator itself. So this is actually the second in two questions that I think often comes up when people want to start their investing journey. The first one is around, I've got this money, should I invest all of it now or should I progressively add it in over time? And this is actually a well answered, well talked about question on the internet, and you can look it up. It's basically LSI versus DCA, which is lump sum investing versus dollar cost averaging. Sorry, it took a second to get there, but dollar cost averaging. And this is often, I think the conclusion is actually lump sum investing under most circumstances, but read the research, have a look into it. I'll leave links below. You then have to decide what are you going to do with any new money that you're going to earn over time. So, you've started with your initial amount. Then as you earn more money over time, how frequently and how much should you be investing into the share market if you want to try and optimize for it? And that's what we're going to talk about in this video, because often I guess this question then comes down to is, should I just keep money on the side and wait for the share market to crash and then go in and try and buy stuff? Or should I do dollar cost averaging again with any new money I'm earning? Now, the general thinking around this is you should stick to dollar cost averaging because, first of all, when it comes to the alternative, it's hard to time the market. You don't know when it might drop by 10, 20%. You don't know when the next COVID is coming. And therefore, that's because COVID times were a great time to invest in the share market. Things that were perfectly fine were suddenly very cheap. And you could buy it at a lower price and then it would rocket up over time. But that's hard to predict. Who saw it coming? So that's one thing. The other thing is it's quite emotional when you do try and time the market and you try and get into the market at certain times, whereas dollar cost averaging takes the market timing and the emotions out of it. You just know every month or every couple of months, you invest this amount of money into the share market and you just keep doing that consistently. So the 5 key factors that come into play are these. The first is the frequency with which you're getting paid. Second is how much are you setting aside from that earning towards what you want to invest in. Third is around the interest that you're generating in your account as you're waiting to invest it into the share market, because that can also have a bit of an impact. Then the next is around what's your assumption around how much the share market is growing. I wouldn't play too much around with this, but you need to put in some kind of assumption around how much you think the share market is going to be growing at over the next few years. And lastly, it's your brokerage rate. What's your transaction fee? If you're with ComSec, it's this. If you're with NAB Trade, it's this. If you're with CMC, it's another number. It's whatever it is, you need to have that ready to go. And what this essentially comes down to is you're trying to find a balance between putting money into the share market at a consistent rate, but not putting it in so frequently that you're losing a lot in terms of transaction costs. So you're getting hit a lot on brokerage, but not putting it in too infrequently that the gains that the share market is having while you're not putting money into it is not being missed out on. So let's now talk about the actual investing frequency calculator that you can use online. Now there's a few out there and I'll leave links below to some alternatives that you can use. But the one I like to use is the one from Perla, which is also a great investing platform. You can check out the investing frequency calculator that they have on their website. And it looks like this when you go to it. It's pretty straightforward, and like I said, it's going to be pretty intuitive. But here are the key factors that we talked about. And at the end on the side, it tells you right there the ideal investing frequency and the investment amount that you should be putting in. So it's pretty straightforward. So let's go through 1 or 2 examples. So the first one is, let's say you get paid fortnightly and you're saving about $500 each fortnight that you want to put towards the share market. You want to put towards an ETF like VAS, A200, IndyQ, whatever. Now, the account that you're setting that aside in, or the savings interest rate that you can get, that's where you put in around 1%. I think that's pretty standard these days. I mean, it wasn't long ago. It used to be like 3%, which was like such a big deal. Investment earnings, 7%. This is the default number. I wouldn't play around with this. I think 7% is a very reasonable number. Whether or not you're including inflation, just go with 7%. It's fine. How much does it cost to make an investment? This is your brokerage cost. So I think the lowest is probably free. There are free accounts out there, which is usually the micro investing platforms. But for most, it's going to be somewhere around like your ComSecs, your CMCs, $10 up to $20 is, I would say, the range. So that's the number you put in. So in this example, let's say you are putting $500, assume 7% growth. You're going to, your ideal investing frequency is every 4 pay periods, which is every 2 months in this case, and you should be investing around $2,000. That's it. That's the optimal amount to be putting in. So let's now look at an example where your brokerage is a little bit higher. So let's say it's $20 on that $3,000 transaction. So this is like the difference between, say, a CMC or a Perla or a Self-Wealth and a ComSec, because ComSec has a much higher brokerage rate. What does it say for this? In this case, you can see all we've done is change the $20 brokerage fee. Suddenly the ideal investing frequency has gone up to 6 periods, which is every 3 months, and you need to be investing $3,000. And the reasoning here is because you're spending a little bit more on brokerage, you should be investing less frequently and a larger amount so you can minimize your brokerage burn, your transaction fees. Now, if you play around with this, you'll also get a bit of an idea of the underlying thinking around it. And it's kind of cool when you have these online calculators because it's, risk-free for you, and you get a feel for, so that's what's actually causing it to go up or down. And in this case, let's say take the previous example, but we'll bump up how much we think the share market is growing by. So again, I would advise against this, but this is a nice way of sort of seeing what the underlying mechanisms are doing. So here we've bumped up the growth rate to 10%. So we're saying the share market is actually growing faster than we were saying before. And you can see from 6 periods at $3,000 per period, it's now saying you should be buying every 5th period at $2,500. Because the share market is now expected to be growing faster, you don't want to spend too much time out of the market. So it's saying the more frequent amount that you should be putting in is $2,500 at 5 pay periods. So you can kind of see if the share market is growing quite quickly, it's worth losing a bit of money in terms of brokerage to make sure you're not missing out on those gains. That's the underlying thinking here. But if you can optimize for brokerage and you can have a lower brokerage amount, then you can probably buy even more frequently as well. Now, the reason I also like Pearl is when you scroll down, you see this kind of graph where they'll show you 4 key bars. And the first is, what would you have in terms of money if you had just left it in your savings account the whole time? And these numbers, I think, are from the $520 brokerage fee with 7% growth rate. It's saying it's about $136,000. Then if you invested at the optimal frequency, the third one from the left, that's the optimal frequency that it was recommending, you'll have $200,000. So immediately you can see that's the difference between investing in the share market and not investing in the share market over a 10-year period. That's the gains that you're getting, or you're missing out on if you just leave it in savings. But the alternatives, the one on the left and the one on the right to the one in the middle, investing at half optimal frequency and investing at twice optimal frequency, you can see the dollar numbers are actually not that dramatically different. And this is where you're optimizing, but it's not the end of the world if you don't necessarily follow this stuff. Because you can see, the optimal amount, you're going to get $215,000. But if you go half optimal frequency, which I imagine is saying you go at half that rate, you get a little bit less. Or if you go at double the rate, you invest more frequently than you were saying before, you still get a little bit less. So we're not talking big numbers. Now, obviously this will grow over time, but use the calculator as a bit of a guide to tell you what your general frequency should be, but don't feel like you have to necessarily stick to it because we're not talking big numbers even over a 10-year period. So hopefully that was a nice, quick, short, sharp video to get you into that mindset around how do I optimize for brokerage and the growth rate of the share market. Please do consider subscribing. I will do another video where we'll look at that lump sum investing and dollar cost averaging topic where there's a little bit more research around it to support it. And I'm not sure if there are actual online calculators, but if there are, I'll go through them as well. And I'll see you in the next video. Bye for now.